welcome to the Inside Track on Real Estate with the Dekker Team, and I am Yetta Dekker, and today I'm here with...
Ryan Dekker.
Absolutely, and today we're going to talk about investing, Ryan's favorite real estate topic, isn't it?
It is.
And one he has a lot of expertise in, so we're going to teach you hopefully lots today. You'll pick up a tip or two, and also remember that we do an investing workshop or a wealth building workshop once a month on the second Thursday of every month.
We also do a buyer's workshop, which is on the third Thursday. And what else do we do?
We also do a financial fitness workshop on the fourth Thursday of every month.
Absolutely.
There you go. And so investing, Ryan, investing in real estate, I suppose, is specifically what you are passionate about.
Yeah, I mean, investing in general is awesome. Businesses, stocks, bonds, mutual funds is what you hear a lot of. I don't find there's as much control in there. People don't understand what they're doing as much. Real estate and businesses, to me, is where the real money is to be made and where the knowledge that you have can be used better.
Right, and you've got more control.
Yeah.
You've got more ability to actually manage that investment and make sure it performs well for you.
Yeah.
All right. So let's talk a little bit about speculation.
Okay. So we're going to talk about real estate. Specifically, speculation in real estate would be buying something like a new build and you're buying it speculating that it's going to go up in value. Or you're buying a raw piece of land speculating that someday you're going to get to develop it. So it's in the future, it's not current.
Right. And so you've talked about two very different things, I think. One is a home that is going to, it's speculation, except it's going to be built in the next 1 year, 2 years, 3 years. You've got a reasonably short timeline, so you may be able to project out a little bit.
So let's talk about the risks and assets of both of those. So that's the first one, and the second one is the land.
Right, and the land, you may have something where zoning application is already in, or it may be something where you just think that maybe down the road sewer and water is going to come to the community, or maybe down the road the village boundaries are going to include that property, or that the zoning in a downtown core is going to go from being only single family to maybe multiple family on a specific lot. So that would be speculation where you have very little real knowledge or control.
Well, some might have great knowledge there and they can do well in that, but that's the minority. The majority of people don't know what the planning office is doing and where they're heading. And a few do, and they do very well at speculating in that area.
Right.
And it's not the average.
Right, and so that's not for everybody probably.
That's correct.
And generally your first one or two may be the school of hard knocks.
If you go that route, yeah.
Probably, right?
Probably.
Unless you align yourself with somebody that's already done it before.
Yep.
Then maybe you reduce your risk.
Yeah, you mitigate a bit of that knowledge gap.
Right. Okay, so what's the difference between those two types of speculation?
So first off, when you're buying land, do you have income?
Right.
Generally not.
No, you don't.
I mean, you might
hopefully
rent
you
it
have
to
some
a
income
farmer.
somewhere else.
Yeah, but for that land, that
Right.
investment, an investment is something that pays you money.
Right.
Right? And so are you getting any money during that time? Maybe a little bit to cover the taxes, but generally not.
Right.
It's totally speculation. And then we go into the new build or something that's being built, and we're assuming it'll be built in 2 years, but we're not 100% sure. There could be holdups. There could be not enough money. There's all sorts of things that could happen. And so some of the risks are you have a mortgage that you're hoping to get in 2 years from now. What if the interest rates change? What if you lose your job? What if? So there's a lot of risks that are involved with speculation. Do you have taxes? No. Do you have a mortgage payment? No. You just have your down payment. So with new builds, they can be very attractive because you don't need to have a lot of money.
Right.
That's why a lot of people like them.
And so as long as the market's going up,
you're doing well, hopefully. The issue is what happens if you can't get the rents you were hoping for. Again, what happens if you lost your job and you now can't get the mortgage you were hoping for and you default and lose all the money you put in?
Or be sued.
Generally, you can be sued. Generally, with the builders, they'll just take your deposit and not go through the court process.
Right, but they'll take a fair bit of deposit money.
They'll take all the deposit money.
And they'll be taking a fair bit through the process. So it's not like you only have $5,000 invested.
No.
You'll have had a significant, depending on the price range of the property,
Usually 15%.
Right, of money already tied up by the time you wouldn't be able to close.
Mm-hmm.
Okay.
Absolutely.
Okay.
And so speculating there, hopefully it'll go up in value. Same with the land. Hopefully it'll change use, or hopefully you'll be able to do something with it later. But it's not creating any current income, and there's a fair number of risks. And I keep using the word mitigation. So I'm going to explain that real quick. What is mitigation? Mitigation is, for example, your house could burn down at any time. You know, something could happen, a wire could get cut, a squirrel could chew it, you could have a fire. And so we can't eliminate that risk. But if it does happen, we have insurance to cover it. So it's now mitigated. I'm not worried if my house burns down.
As long as nobody's in it.
Yeah, I hear you. As long as no one's injured, because the cost will be paid for. So financially, the risk is mitigated, right?
Right.
And so same with, there's other mitigations you can use when using speculation housing. And we'll get into that a little bit later.
Will we?
Yeah,
Okay,
we will.
perfect. And so anything else that our viewers and our listeners need to be aware of in relation to speculation type real estate purchasing?
Anything else? Like we said before, there's a fair number of risks. So we'll look at mitigating them a little bit later in the show.
Yep.
So stay tuned.
Right.
And there can be really good incomes, just not always. So
Right.
be careful. Be
Right.
careful on this one.
Because we've had lots of clients do this and it's worked out really well.
Yes.
And I've heard lots of
5
other
years ago.
stories.
And lately
Yeah.
it's becoming less.
Okay. So timing it, and it's always hard to time a market.
That's
certainly,
why it's speculating.
right? So is a big piece of it. Watching the
Absolutely.
trends and the way it's tending versus what
Yeah.
has just happened. Because
Absolutely.
what's just happened is maybe a predictor, and what's coming down the pipe is equally as big a predictor of what's going to happen.
Yep.
Okay, and so let's talk about existing property in relation to investing, because then we'll talk about the mitigation process in relation to both, right?
Yes,
As an
that's
overall
right.
blanket. Okay.
So existing real estate, the nice thing with it is it's already built. So you get your mortgage today, right? You get locked in, you get today's rates, you get today's mortgage. In investing, I suggest going with a fixed term. Variable, you might pay less, but if the rates jump 3%, you might lose your shirt, you're no longer cash flow positive. So locking in for 5 years mitigates that risk.
Right.
So we're talking a little bit about mitigating already, but
You can't help
I
yourself.
can't help it. It's
That
good
is
stuff.
where Ryan goes, as he's helping his buyers invest wisely in real estate, whether it be a multifamily or whether it be a single family, whether it be a condominium style property or something in a freehold. Always he is focused on how do we reduce your risk? How do we get rid of as much of those variables that could bite you? Because I think everybody has a horror story or knows of somebody that has a horror story in relation to investing, so in real estate specifically. So it sounds scary.
It can, yeah.
And that's why Ryan's focus is how do we help reduce those issues and give you confidence and peace of mind, because nothing is a good investment if you don't have peace of mind, right? So again, back to existing real estate.
Yeah. So we know what it should rent for because we can see what other properties have rented for. We know what today's rents are.
Right.
And we can hopefully get it rented either before you get it or it's already rented.
Right.
And so you don't have a vacancy period. You don't have a question of will it cash flow or will it not. We should be able to predict that fairly accurately.
Right.
Not perfectly, but accurately. And so other things about existing is, structurally it's sound because you can do a building
Or
inspection.
not, and then you
or
don't
not,
buy it,
or
right?
you get a deal and fix it up. Like, there's different models, but you know what's going on. There's
Right.
less surprises.
Right. And what else is of value to a prospective buyer, landlord, in relation to existing?
You know where the market's heading generally?
Right.
You can take a look at the neighborhood's history and see, is this a good neighborhood? Is this a bad neighborhood? You can predict what kind of people live in the neighborhood, and you can choose what kind of clientele you want. So do you want more of a lower end market? Some people love that. It's cheaper to get into. They only have rents of $600 or $700, but they get a very different clientele than someone who's paying $1,500, has a young family, a steady job. Very different. And you can choose that by looking at what's already out there.
Right, and choosing where you want to be and what kind of property you're purchasing.
Absolutely.
Okay, so are we ready to move to risk mitigation? Is that your favorite thing?
No, my favorite thing is return.
Okay,
But
do we want to
return isn't usable if you lose it.
say that again?
Yeah. So often people say, the higher the rate of return, the more the risk. That's not true. I get more rate of return than almost anyone I know, and my risk is mitigated. So
Okay.
is there risk? Absolutely. But have we encompassed it so it's not so risky anymore? Yeah.
Okay.
And that's what's important.
So how do you, rate of return doesn't
Yeah.
equal risk?
No, but that's
So-
what we're taught by the banks and by a lot of the financial institutes is the higher the rate of return, the higher the risk. Well, I can give you a guaranteed investment that will lose you money because it's not keeping up with inflation. So is that risky? Absolutely. You're losing buying power every day. But in the bank's eyes, it's not risky because you can't lose the initial investment.
Right.
So it's really not true. And it's something that needs to be busted through in a lot of people's minds. Now, can I get you something risky with a lot of rate of return? Yeah, but that's not something I'd invest in because I don't want to lose my money. I want to mitigate the risk as we go.
Right. So you want to work and balance rate of return with reduction of risk.
Yep. And now, for the listeners, a lot of people think, 5% is a good rate of return or 6%. I believe that I need anywhere between 15 and 25% rate of return to
On
even
your
be-
money.
on my money, to even be worth my time.
Right.
And people are like, that's not possible. Come to my workshop. It's possible. We'll teach you how to do it every day of the week. And it's not crazy. It's not something new. It's just using proven, time-tested real estate models, taking the average and making them great by mitigation and making sure your rate of return's there from the start.
And using often other people's money
Yeah.
for a portion of the investing, which is what
Often.
gives you such a great rate of return, right?
Yeah.
Because if you have too much of your own money in, now the money has to work too hard and you're not going to get 15+%.
No, and that's not a bad thing either. If you want to buy it outright, there's ways to get 10% without being leveraged.
Right.
Now, the 15 to 25, I don't know of a way in real estate. There's ways in business, but I don't know of a way in real estate where you can do that without a lot of risk.
Right.
And so, but 15, 10%, 7% is a joke in my opinion. That's all very, very easy to get for people.
Okay.
And so, yeah, come to the workshop. And how do they register for that?
Well, they simply would call us at 613-860-4663, 613-860-HOME, or they could email us at info@dekkerteam.com. And again, the investor workshop is the second Thursday, the financial fitness is the fourth Thursday, and the buyer workshop is the third Thursday. And they all start somewhere between 6 and 6:30 and run till 8 or 8:30, depending on which workshop. So we would give you those details when you registered. And if you want to be on Ryan's investment of the week video, that is a pretty cool thing as well. So at this point in the show, I just want to remind you that we've been talking about investing in real estate, speculation, existing, and a little bit of risk mitigation. And if you've missed it, you want to go back and listen to it. And also, you'll want to register, again, at that same email address, info@dekkerteam.com, for the investment opportunity of the week. Right? You go hunting all over the place to find them.
Yeah,
And we love
sometimes it's
that.
a property, sometimes it's information. It's always something new that people can look at and hopefully learn and help them grow themselves as well as their investing portfolio.
And make better decisions.
Make great decisions.
All
yeah.
right. So risk mitigation, Ryan.
Yeah. So we've finished existing properties.
Yep.
Right? We've talked about rate of return and how
Yep.
risk mitigation is the other side, because there is risk and how do we mitigate that. Let's talk about tenants. Let's
Okay.
go there for a minute. How do we ensure that we get a good tenant? Because we've all heard horror stories of the tenant who did tons of bad stuff, broke the walls, had a cat that peed all over the carpets, the dog that...
Yeah. Okay. We don't.
We've
had them.
heard them. You've
We've
heard
even
them.
had them.
We've had them.
And what I can tell you is when we've had them, it's when we didn't listen to what we knew was good, sound decision making. You want to make sure that their credit worthiness is in place, that there's been a history. And it's not that you don't want to give somebody a chance, just recognize that if you do, you're increasing your risk.
Yeah.
If you take somebody that has already had issue with credit or paying previously other landlords, you increase the probability that you may have that same risk. Yeah. So you'll often want to call not the current landlord,
but 2 landlords ago.
Right, because
to see what's really happened.
Right, because that's probably where you're going to get the best information, right?
Yeah, there's 3 big tests for a tenant.
Okay.
The first one is the gut check. So when you meet them, and people think this is silly, it's so huge. The gut test works so often. You meet someone, how do you feel about them? And that's, are these people nice? Are they kind to you? Or are they disrespectful? Do they walk across your lawn, or do they use the pathway?
That might be cultural too.
Could be, but generally...
But you want to watch in general what's going on,
Generally, you
right?
can get a sense from people, right? And I don't mean to be, too picky in this, and yet you're smart people who are listening today, or else you wouldn't be listening. And, use your gut check. This is huge. If you get a bad feeling, it's not worth it.
Right.
Because you're going to have these people hopefully for a long time, and they're going to be paying you, and you're going to be interacting with them. If you have a manager, then the manager will be doing the gut test. It's very important. Step 2 is your credit check, which you already spoke about. And they're very important. You can tell where they've been, what they've gone through, and where they're headed by a credit check. What I mean by that is sometimes you can tell that they went through a divorce because there was a blip in their credit, but since then they've been really great. And so you can probably decide, if you want, that these people are going to be good moving forward. But if their credit has been bad the whole way through, then pretty sure it's going to continue on the same track. And if it's been great the whole way through, then again, unless something major happens like illness or loss of job, you can assume that they're going to continue to pay their bills and pay their landlord.
Because they likely will. Because they've shown a history and a character of behavior.
Yeah.
Okay, so that's 2.
2, and, oh no, I've lost my third. Your third is references. So you call their friends, you call their current and past landlord, you call their employer, and you just have a chat on who this person is, what are they like, and once you start to hear from all different people, you'll get a sense, because they'll be similar, because people present themselves often to everyone the same. Maybe their friends a little differently, but their friends would normally say something nice, you'd hope. Right?
You would hope.
You'd hope. And so those are the 3, is the gut check, the credit check, and the reference check. Right. And if those 3 turn out, you have a really good chance of having a great tenant.
Right. And another thing I've often suggested to our clients that have been investing in real estate is if you have the opportunity to pick up the deposit check or pick up something from the home of where the tenant is currently living, provided they're in your city, that will give you quite an extra insight.
Or sign the lease with them, or do something in their area.
Right, before you have a final commitment that you must move ahead. And that just is another help to the gut check, really.
Yeah.
And a little more information. Okay, perfect. So anything else we need to know about?
Mitigation?
Yeah.
Well, we only have so much time.
Right. Okay, let's do the highlights.
So we talked about tenant.
Yeah.
We did talk about interest rate.
Yeah.
Let's talk about our speculation. How do we mitigate buying a new build with all the risks we spoke about in the beginning of the show? How do we mitigate those?
Yeah, how do you, Ryan?
How do we? Well, there's a really cool product coming out in Ottawa. It's not here yet. And it's a fully finished student housing unit, and it's luxury. It's really nice. But when I say luxury, they haven't put in pools or the really expensive things to maintain. They've put in a gym and some studying areas so the students get what they need without having a high cost to the owners of the building. And they have a property manager on site, which is awesome, so you don't have to worry about finding the students. How do you find them? They pre-do it. It's 2 years out, and the launch date isn't yet. So if you want to know more, we're going to tell you how to find out more in a minute. 2 years out, so that's where you get your speculation, because we're assuming it's going to go up in value. but we don't know for sure. But the mitigation is we have our tenants guaranteed. We have our financing guaranteed by the bank.
It's in place already.
And it's in place already, and it cash flows positive for the first 2 years, guaranteed.
Okay.
So if they can't find a tenant, you're getting the money anyways. And so that's mitigating risk. You know, the risk is there, but you don't have the risk. The company who's building it does.
Right.
So
because they're so sold on their product.
They're sold on their product.
Because there isn't enough student housing.
Nice student housing. Near the universities, yeah.
Right. In Ottawa. So this is an Ottawa local product. So buying local often reduces your risk too. Because you understand it better and you can touch it and you can feel it and you can see it and all of that.
Yeah, the lot of risk is eliminated just by knowing it's there, seeing it go up. You know, there's no fraudulence going on. There's a lot of reasons why I like Ottawa and a lot of reasons why I like Canada in general for mitigating risk. Do you want me to go into those?
Sure.
Okay, so Ottawa, why do we like Ottawa? Because it's so stable. It's so stable. We've got the government, but not only do we have the government, we have high tech. We've got all sorts of industries here that make
service industry,
service
really.
as well, that make it very stable. So can we predict where it's heading in the next 10, 15 years? We can predict. We can't, what do you
guarantee.
Call that? Guarantee, thank
Right.
you. We can predict where it's headed because of where it's been and where it's been heading,
Right.
and our population growth. And, you know, we're still one of the number one places to live in the world. There's a lot of great things about Ottawa. Cash flow can be tight, right? And so we want to make sure it's cash flow positive. Robert Kiyosaki talks about anything that isn't giving you money is now a liability.
Right.
It's costing you money. It's taking. And so even though you'd be getting property increase and mortgage pay down, he's thinking that because it's not giving you money every month, it's a liability.
Right.
And I'm kind of on the fence there because you're still making money, but yes, you do need to write a check. So there's only so many you can have, right? Whereas if it's cash flow positive, you can continue to grow your empire or your monopoly, if you want to call it.
You like Monopoly.
I love Monopoly.
You always loved Monopoly as a kid too. So, So Ryan, cash flow.
Yeah.
What's your statement around that? What should we be looking for? What?
Oh, okay. I was going to say cash flow rocks, but that's not what you're looking for.
Cash flow does rock, Ryan.
Cash flow rocks.
At solid rock.
Sure. Yeah,
Okay.
at solid rock, cash flow rocks.
Okay.
That's cute. So what are we looking for? In Ottawa, we're really looking for something positive.
Right.
Now, depending on your situation, maybe you're retiring and you need more cash flow. Well, there's different markets around Ottawa that give you more cash flow. Also, we can put more money in, less rate of return, but more cash flow. So it really depends on the person's situation.
Okay.
And the more cash flow you have, the more current tax you have to pay because it's as income. So it's done at your highest tax bracket. Whereas any property increase is taxed very nicely for you.
Right.
One, you don't have to pay it until you sell it. And two, there are some small variances on that, but we'll talk to your accountant or come see me. And then your capital gains tax, which means you're only getting taxed half of what you would be taxed if it was income. So really great tax advantages.
Okay. So hopefully you've learned a lot on this show about investing in real estate, the ups, the downs, and mostly the ups actually of the whole thing. And if you would like to have a one-on-one consultation with Ryan or with Ken, our investment specialist, the best way to do that is to attend one of their workshops, unless you're already a savvy investor and you just want to get together with them and have them help you find the ideal property or properties, as often is the case. Attend one of the workshops, especially the wealth building one, because that'll give you a good base knowledge, and then they'll offer to do a one-on-one consultation with you to ensure you have the next few steps in place as to how to move forward in your unique and specific scenario. Is that right, Ryan?
That's exactly right.
Okay. So all you have to do is connect with us at 613-860-4663. And that's even if you have an investment question for Ryan, if you want to get signed up for his videos, or if you want to attend a workshop or have a consultation because you're already at that stage.
Yeah.
Right? Or email us at info@dekkerteam.com. And you could connect with Ryan at dekkerteam.com too. He is available to you. And so a couple of properties, they are not specifically residential investment in terms of you may put a tenant in them. However, they're amazing properties to live in, and the numbers I think could work okay. One is in Greeley, and it is only $435,000 for a 4-bedroom, 2-story in a great family neighborhood, like absolutely perfect.
Wow.
Yeah, quite true awesome investment, whether it's for living in or for turning into an investment property, because even the one you live in ought to be an investment as well.
Yeah.
Right?
It's often people's biggest asset.
Yeah.
Where, again, as we talked about, Robert Kiyosaki would say it's a liability.
Right.
However, many people, especially in Ottawa, retire on just their home alone.
Which is fantastic, right? And then we also have another really nice 2-story as well in Barhaven, only built a few years ago, a beautiful 3-bedroom at $425,000. So almost the same price point, slightly different neighborhoods, both really good spots that you might want to call home. So if you're interested in either of those, you want to connect with us at the team. If you have questions, if you want to even be a guest on the show, you'll want to connect with us. Mm-hmm. So Ryan, what would be some parting thoughts on investing in real estate that you want to ensure you pass on to our viewers and listeners?
Keep learning.
Okay.
That's really it. Keep your act sharp, which means keep the knowledge going. Read great books. Come to our investor workshops. If you want to invest, if you want to make money, you got to keep learning. And
in a pretty risk-reduced environment.
Risk-mitigated environment. That's right.
Right.
Because you can learn about that stuff.
Right, because that's all part of it. So thanks for joining us on the Inside Track today on real estate. And Ryan, thank you.
My pleasure.
It's kind of nice to hang out with my kids, sitting in front of the cameras and having a conversation with you. We'll talk to you soon.
What you wanna do? One man is showing